So here's the reality. There are two major developments that reveal just how much pressure is building, and China knows exactly what game the US is playing. But this time, all the tactics, tricks, and strategies that worked before, especially under Trump at the G7, simply don't work on China anymore. You can't isolate China economically without also isolating yourself. Every move to corner Beijing risks backfiring, because China is far too connected to the rest of the world. Their economy isn't easily boxed in. Unlike the US, Chinese exports are deeply integrated into both global consumer markets and industrial supply chains. They're not going anywhere. Just look at what's actually happening. In the first half of 2025, despite US purchases of Chinese goods falling by 11%, China's total exports grew significantly. Why? Because other markets are stepping up. Exports to Europe rose by 7%, to Africa by a massive 21%, Latin America saw an increase of over 7%, and Southeast Asia, a critical region, is now China's largest customer, with exports there rising 13%. Even Japan, traditionally aligned with the US, is leaning more heavily on Chinese imports. And why wouldn't they? As the US shifts inward, pushing its Made in America agenda under Trump, import volumes are naturally declining. The message is clear. Other nations still need goods, and they're turning to China to get them. We can already see this reshaping global trade patterns. Sectors like autos from Japan and Korea, pharmaceuticals and semiconductors are seeing declining exports to the US, which means they need new buyers. That buyer is increasingly China. And here's the twist. China isn't just exporting more, it's importing more too. In July, Chinese imports rose 4.1%, and that's significant. It shows that China is starting to absorb more global supply even as the US retreats. China's retail sales are growing almost in sync with its GDP, around 5%, and that's being driven by a growing, confident middle class. That growth lifts not just domestic Chinese companies, but exporters around the world. Take a closer look at domestic trends in China. Food consumption is up 12%. Home appliances surged by over 30%. This is what economic rebalancing looks like. It's not dramatic, it's gradual. But it's happening right in front of us. And as Chinese consumers gain more spending power, they'll begin importing more goods globally. It's only a matter of time. Now, the US knows it can't push China into submission. Trying to suffocate their economy is only creating a self-inflicted wound. Sure, embargoes might force Americans to buy American, but it comes at a cost. Prices could skyrocket by 50% or more in some sectors. That would directly harm the very consumer base Trump claims to support. It would destroy demand, not stimulate it. And that's why Washington just extended a 90-day truce with China. Without it, we were heading straight into economic disaster. This isn't the first pause. We just had another one a few weeks ago. The tariff structure hasn't changed, but the extension offers breathing room. That's why you're seeing markets in both the US and China rebounding. And realistically, these 90-day extensions will probably continue. Nobody wants to be the one to pull the plug entirely. But we need to call out the spin. Trump, Besant, Lutnick, they keep selling the idea that tariffs are paid by other countries. It's simply not true. Just last week, Besant was backed into a corner during a press conference and still clung to the claim that exporters are the ones taking the hit, not US consumers. But that's not how global trade works. Countries like Brazil, for example, aren't going to eat those costs. They'll just sell elsewhere. And the reality is, many industries cannot absorb a 30% blow to their margins. Even a 10% margin loss is enough to trigger layoffs, downsizing, or complete exits from certain markets. This brings us to where we really are, 4 months into the renewed US-China trade war. The tariff structure? Trump is hitting Chinese exports with a 30% tariff, while China is responding with a 10% import tax on US goods. But who's absorbing the real pain? China is adjusting by trading more with Europe, BRICS, and other fast-growing economies that offer either better or cheaper alternatives. Their consumers are largely unaffected. On the flip side, US businesses, both big and small, are hurting. Prices are rising, demand is falling, and companies are being squeezed. And we're seeing the results in real numbers. In July alone, 71 large American companies filed for bankruptcy. That follows 65 bankruptcies in both June and May. So far this year, 446 corporate bankruptcies, more than we saw during the peak of the 2020 pandemic. The damage is not theoretical. It's happening, it's measurable, and it's getting worse. Even Besant had to eventually concede that importers, not foreign governments, pay the tariffs. This raises costs, weakens competitiveness, and kills demand. It's a recipe for economic stagnation, not growth. But here's the kicker. Even with all these tariffs, the revenue they generate isn't enough to balance what Trump is spending. In July, the US federal deficit exploded to $291 billion, even with a $21 billion boost from tariffs. That's a 2% increase in revenue. while government spending surged by 10%. So after everything, the trade war, the tariffs, the tough on China posturing, America is deeper in debt and more addicted to spending than ever. The harsh truth? Tariffs are no longer effective. We're well past the point of diminishing returns. Further escalation brings only more damage, not leverage. And while the U.S. continues to push its reshoring strategy, trying to bring manufacturing and supply chains back home, the idea of cutting off China completely just isn't practical. U.S. factories still rely on Chinese components, Chinese materials, and Chinese technologies. You can't rebuild domestic industry while simultaneously choking off access to critical global inputs. And that's where we stand. The U.S. is gambling big, but unless it comes to terms with economic reality, the cost of that gamble could be enormous. Let's be brutally honest. China still holds massive leverage over the United States economy, and no amount of posturing or tariffs can erase that overnight. You can't build electric vehicles, you can't manufacture cutting-edge semiconductors, and you certainly can't produce high-grade military tech at any real scale without China. They dominate the supply chain of rare earth elements and critical metals, and when 70% of the rare earths flowing into the U.S. over the past 4 years came directly from China, that's not a crack in the foundation. That's a gaping structural flaw. You can talk about sourcing from Malaysia, Japan, even Russia, but let's be clear. The supply pool is tiny, and prices will skyrocket. You're squeezing blood from a stone. That's why Scott Bessent, and let's face it, Trump too, folded when it came to Beijing. They weren't making a concession. They were avoiding economic collapse. The entire American manufacturing revival depends on China playing nice. Without them, the whole strategy unravels. It's like planning a grand banquet while your biggest rival controls the catering, the chairs, the venue, and they've got the keys to the gas line too. You don't antagonize the one holding the lighter, and yet here we are. The chip war has escalated again, and this time it's getting downright hostile. Trump's latest move? Slapping a tax on U.S. chip giants for selling to China. That's right, every chip Nvidia or AMD sells to China now has 15% shaved off the top, siphoned straight to Washington. So from China's perspective, buying U.S. chips means directly funding the U.S. government. Why would they continue playing that game? Naturally, Beijing struck back. They've begun urging Chinese firms to avoid Nvidia's H20 chips altogether. But it's not just a gentle nudge. Regulators are now demanding that companies justify any purchase of American chips. If you're planning to buy, you'd better have a solid strategic reason, because Huawei and other domestic suppliers are right there, waiting. This isn't just a warning shot, it's a paradigm shift. When Beijing says no, Chinese tech giants like Alibaba, ByteDance, Tencent, they listen. No questions, no resistance. Not when political risk is involved. So companies are quietly scaling back their Nvidia orders. Not because there's a ban, but because it's suddenly become politically dangerous. Buying U.S. chips is now seen as disloyal, a liability. And in this climate, even a whiff of disloyalty can get you crushed. So the safer option? Walk away. Or scale down until no one notices. And that's devastating for U.S. chip makers. Nvidia and AMD rely heavily on Chinese sales to fund their insane R&D cycles, to stay ahead in a brutal, high-stakes industry where innovation is everything. And yes, they've got monster margins, 50, 60% and beyond. But without that Chinese revenue, they don't just lose sales. They lose momentum. They lose the edge. And while Washington is busy taxing, restricting, and regulating, Beijing is playing a smarter, longer game, starving U.S. tech of access, not through sanctions or bombs, but with silence, with absence, just not buying. And that's arguably even more effective. Because if U.S. firms can't access the world's largest chip market, their growth shrinks. Their budgets tighten. Their innovation slows. Meanwhile, China catches up. Slowly, then all at once. They see the big picture, and they're executing a plan that bleeds American dominance without ever firing a shot. Welcome to the new normal. Sanctions, tariffs, export restrictions, revenue grabs, political pressure, and outright bans. There are no more gentlemen's agreements, no more quiet diplomacy. This is bare-knuckle, no-rules economic warfare. Everything is on the table. Everything is personal. And everything has consequences. So how big is the fallout? Before Trump's April ban, China was expected to buy 1.5 million high-end chips, 20 billion in sales, just gone. And that was before China made massive progress in their own AI ecosystem. Now we've got DeepSeek, Manus AI, and a wave of homegrown models building real momentum. Meanwhile, China is amping up energy production with solar farms and massive hydroelectric projects like the one in Tibet. That's a perfect storm for rising AI chip demand. And here's the twist. China's cost-cutting strategy now includes a hyper-accelerated push into industrial automation. In April alone, they produced over 71,000 industrial robots, a 52% jump in just 1 month. That's not a fluke. That's an economic transformation. And what do those robots run on? AI chips. It's not hard to see what's happening. Tariffs intended to punish China are actually driving them deeper into independence, innovation, and scale. And this is why Nvidia's Jensen Huang flew to Beijing. He wanted to protect Nvidia's access to the single fastest-growing AI chip market in the world. But the window is closing. Fast. The dream of unfettered access to China's tech sector is fading. Nvidia won't get a free ride. Not anymore. Not unless Washington pulls back entirely. And even then, China may not bite. Why would they? The trade war has turned into a catalyst for domestic acceleration. It's hurting US firms more than it's hurting them. They're insulating themselves step by step, one policy at a time. So now we have to ask, will the US keep pressing the export ban? Will they double down on their chip controls? And is Nvidia's chapter in China already over before the next one even begins? Because right now it's looking like Beijing isn't just fighting back, they're rewriting the rules. And US tech giants are about to learn that in this new game, market access isn't a right. It's a weapon. One China now controls.